Welcome. This is a cyber class replacing the class meeting on Tuesday, December 7th that I can't make, unfortunately. This is the last class with new material, and it's in large part a review of what we've already covered on the previous Thursday, actually, the 2nd. You'll probably notice. We will have an in-class review on Thursday the 9th coming up, and then the final exam will occur a week and a day after that, Friday the 17th of December, 11 a.m. to 1 in Kylie 170. That's the large classroom, not the smaller one upstairs, but the big one downstairs. Problem set 9, which is the last problem set, is currently available, and it's due before class on the 9th. And in part to make up for this, I know this is probably a bit on the clumsy side, it certainly is for me, to do the cyber class. I will be in my office all day on Wednesday, the 8th of December, and will be available for office hours the entire day, and then I'll see you the next day for review on the 9th. Course evaluations. Just to remind you again, please do your course evaluations. That's the URL. Your opinion matters for professors getting or not getting tenure. So for each course you evaluate, you also have a chance to win a bunch of stuff. Parking passes, netbooks, iPods, and much, much more, whatever that may be. I'm not really sure. This is where we are and where we have been. We've been talking about the Federal Reserve, monetary policy, and why it is set up. It basically exists because the Fed is aware that there is an IS curve that relates short-run output to real interest rates, and so it wants to manipulate the real interest rate in order to have some effect on short-run output. And today we are solidifying our discussion of the tools of monetary policy. Well, where have we been? We've talked about how the Fed consists of a board of governors in Washington, D.C. and 12 regional banks around the country. The Federal Open Market Committee is the brains of the operation. That includes the chair, that's currently Ben Bernanke, and 6 other board members, plus 5 regional bank presidents who rotate in and out. The FOMC holds 8 meetings per year, votes on monetary policy. It tends to be a unanimous or close to unanimous type of vote. The Fed effectively sets the Fed funds interest rate, and by doing so can manipulate macroeconomic activity. That's the argument in the IS-MP diagram, that the Fed is aware of the IS curve, and by setting the real interest rate will pick a spot on the IS curve. It can manipulate macroeconomic activity through changing investment, because investment is sensitive to real interest rates. The Fed can manipulate the money supply through changing the monetary base, but banks and depositors also have a say in this. And this is part of what's going on with monetary policy, the quantity side of things. Technically, it tends to be the Fed targeting the price involved here, which is the Fed funds interest rate. And so that's what we're talking about today, is how the Fed actually sets this rate. Well, it's through open market operations, and what that means is the buying or selling of government bonds. The Fed either buys bonds and absorbs the bonds in exchange for cash, which it injects into the banking system, or it sells bonds and absorbs cash from the banking system. And what that does is lower or raise the supply of excess bank reserves, which changes their price. So we think of this as changing the supply of reserves. A change in the supply in a supply and demand framework can change the price given demand. If you reduce supply, what you're doing is you're sort of inching to the left, back up the demand curve. The price will rise. The price is the federal funds rate, and that's how open market operations can raise the Fed funds rate. And the reverse happens if the Fed decides to increase bank reserves. That raises the supply basically and lowers the Fed funds rate. So again, that's the price of banks' excess reserves. It's the Fed funds rate in the market. The Fed can also set the discount rate that it charges on discount loans through the discount window of the Fed, but this is a very rarely used kind of thing. It's only during emergency times. Reserve requirements, as we saw last time, also can be operative, but this doesn't have a particular guaranteed effect on credit. And the Fed typically does not change the reserve requirements and hasn't for many, many years. The Fed picks a Fed funds target rate, and that rate these days is made public. Back in the early 1980s, I believe it was not actually. The Fed went to monetary targeting, and that perhaps had been before that. But ever since the 1980s, late 80s for sure, and possibly early 90s, the Fed has picked a Fed funds target rate. The thing is that the actual rate here, which I'll show you in blue, has not always been exactly what the target was set at. And most especially in the fall of 2008 during all the the financial crisis events that we had talked about in class and also in the documentary that you watched. So especially during this period here in late 2008, there were these very big deviations in the actual Fed funds rate from the target. Well, that has led the Fed to accelerate paying interest on reserves. That's an extra tool that now it has. The Fed can pay an interest rate equal to I sub ER on banks' excess reserves. This was actually legislated prior to the crisis in 2006, but the change was not expected to take effect, or it wasn't legislated to take effect until 2011, and the change was pushed up to 2008 because of the financial crisis. The idea is to provide a lower bound on the Fed funds target, and well, that is the Fed funds rate around the target. And we saw that there were these big changes in the effective rate around the target, especially during that time. The argument is that if banks can earn this excess reserves interest rate by leaving them at the Fed, then they'll never agree to a Fed funds rate that is below whatever the interest rate on excess reserves may be. So the Fed has an additional monetary policy tool, basically. During the crisis of 2008, what happened was that there was targeted liquidity extensions to particular sectors. And unfortunately, that resulted in a rather unknown demand for excess reserves, I believe, which pushed the effective Fed funds rate around quite a bit. Another rationale for changing this policy could also be an argument about efficient versus inefficient taxes. And if reserves held at the Fed because of reserve requirements are not paid, well, that does reflect a tax on banks. They have to hold this cash that doesn't earn any interest, and it's because of the regulation. Basically, it's because of banking regulation, because we don't think that they should be allowed to do whatever they want. That's true. I guess the issue is, what kind of behavior does it tax versus what do we think maybe should be taxed, and are those the same, and maybe those aren't. So Michigan, I think, discusses this a bit, and it is somewhat of an interesting topic, but it's not the main one today. The main topic today is to look at the market for bank reserves and think about the shapes of supply and demand in this market, and they're a little funny. They have this scissor shape, which we saw last time. The price in the market is the Fed funds interest rate that banks charge each other on borrowed reserves. Demanders in the market are actually the sellers of reserves who have to choose to hold reserves that they can lend out. And because of interest paid on reserves, banks will never accept a lower price than this interest rate paid on excess reserves. So demand will start high and then flatten out at this interest rate paid on excess reserves. Banks won't go for anything below that because they don't have to. They can get the interest rate paid on excess reserves. The supply curve in the market for bank reserves is basically determined by the Fed. Now, it is, in fact, other banks. Banks can think about how much they bring to market to some extent, but more or less there's a specific amount of excess reserves that are there, and the Fed will alter that amount of excess reserves through open market operations, through offering bonds that absorb it, or through buying bonds. Either way, it can change the supply of excess reserves. So supply basically is vertical at the quantity that exists in the banking system. But the Fed funds rate can't exceed the discount rate. So the other interest rate that's operative here is the discount rate that's offered by the Fed itself. And the point is that this has to flatten out at this level, because if it didn't, what banks could do, presumably, is borrow in the Fed funds market, borrow in the discount market, and then lend in the Fed funds market. It would be a way of making infinite profits, basically. Borrowing if the Fed funds rate were ever above the discount rate, they could borrow at the discount rate and lend at the Fed funds rate to other banks, and the Fed would never allow them to do that. That would not be a particularly useful thing to happen. It would be a way of expanding credit infinitely. Well, as in any other market, so this looks a little weird. The point is that the scissors help kind of refine where this equilibrium is going to be. But as in any other market, the intersection of supply and demand determines what the Fed funds rate will be. So here that's going to be the Fed funds rate. That's the intersection of these two things. And by design, this is between the interest rate paid on excess reserves and the interest rate paid on discount loans. That's I sub D is the bigger one, which is the discount rate lending from the Fed itself. And so by design, with the funny scissor effect here, the Fed funds rate is always between these two things. Usually, the supply of reserves is going to be what we're talking about changing. The Fed conducts open market operations and either raises or lowers the supply of reserves that's out there. Well, suppose the Fed wanted to raise the Fed funds rate. What would the Fed do to the supply of reserves? Basically, it needs to move the supply curve to the left if it wants a higher Fed funds rate. And what it must do then is conduct open market operations in selling bonds, which banks buy using reserves. So the Fed offers bonds at a favorable price. Banks buy them up using reserves. That removes reserves from the system, and supply will shift to the left. The Fed funds rate rises because the Fed has removed reserves from the banking system, and so the intersection of supply and demand is further to the left than it was. By contrast, suppose the Fed wanted to lower the Fed funds rate. Well, what would the Fed do there? Just the reverse. The Fed has to raise the supply of bank reserves, shifting the supply curve to the right, so the Fed will conduct open market operations to buy bonds. And what happens there is the Fed announces that it will buy at some favorable price to sellers, a high price basically. And then what that does is injects new reserves, new cash, which takes the form of reserves initially, into banks. And that will raise the supply of reserves. As the supply curve shifts to the right, there'll be a new intersection of supply and demand, and the Fed funds rate will fall. Well, what else can alter this basic picture other than open market operations? It's true that the Fed can change the discount rate, and if it did that, what we would see is a raising or more likely a lowering of this hook here that's in the upper part of the scissors. So that's another tool that could be used. It often doesn't get moved independently, although sometimes we've seen it in historical periods. The Fed could set a higher reserve requirement. It typically doesn't, but that could, in theory, happen. And if it does, the demand for reserves would shift out, which would raise the Fed funds rate. It's because with a higher reserve requirement, there's a greater demand for reserves because banks need more reserves basically to meet the higher reserve requirement. Also, if banks just chose independently to hold more excess reserves, demand would also shift out. And so here is the bottom two bullets. That's what either one of these things would look like. There would be this higher Fed funds rate target in here at the higher level because the demand for reserves might increase. Now, just stepping back for a second, the last bullet, banks choosing to hold more excess reserves, is in fact what we were considering in the last class. That had happened in 2008, and that puts upward pressure on the Fed funds rate unless the Fed accommodated the increase in demand. And in fact, it did, increasing the supply of bank reserves rather remarkably. Of course, that's the only thing that pushed it down. So these things really, especially the last bullet point, really can happen in real life.